Welcome to the 2025 Autumn Statement Edition of the OR Talks podcast. Today I'll be discussing all things about the Autumn Statement. Here are your hosts, Neil Seeger
and Marc.
So we're back.
We are.
We're back. It has been a while. It's good to be back.
It is, and we've got the budget hot off the press.
The budget, the Autumn Statement hot off the press.
Yeah.
So I mean, there was an awful lot of noise. Hopefully Marc's going to be going through in a lot more detail about some of the things that came up. But there was rumours, change of VAT thresholds, income tax, national insurance changes. They were going to take loads more tax off us.
Yeah, there was a lot of scaremongering before, wasn't there?
Everyone
was getting quite panicky about what she was going to do, what wasn't going to happen, and in the end, it wasn't as bad as what first feared.
It wasn't. I mean, there are some changes, but hopefully today we'll squash some of those myths and give you an insight as to what has changed and when it's going to change. That's going to be the key from today.
Yeah, so we'll just go over sort of the headline sort of points from the budget that were going to affect people, sort of our sort of client base and things like that. So
the first one that springs to my mind is dividends.
Yeah.
Okay, so dividends are what people pay themselves out of the limited companies, or gets paid out of, if you've got any shareholding, basically. So that rate up to now in this tax year has been
to 8.75%, isn't it?
Yeah.
It's really easy percentages.
Yeah, I was about to say that, and 33.75 you go above your 50, and that's going to be going up.
Yeah, so from April 26, dividends are going to have an extra 2% tax on them. So dividends liable to income tax, no national insurance on them, but up in the income tax on them at 2%.
So that's up until, so in this tax year we're speaking to the 5th of April 2026, that's at 8.75. And then if it goes above that, after we go to that point, so the 6th of April 2026 onwards,
it's then 2% on top of it.
So 10.75%.
It is, yeah.
35.75%, wow.
But the good thing on that is you've got time between now and the end of the tax year to do some forward planning.
And that's a good thing, isn't it? Looking at your limited company's performance, and also then looking at what dividends you can declare and whether you can declare them in this tax year.
Exactly, yeah. So that's what we're here for, really. So be busy doing that sort of thing.
Absolutely. Strategy planning, and that's the really nice thing about these taxes. You always say, Marc, you can always forward plan.
That's it, yeah. Take note of what's happened, listen to us, and come and speak to us, really. And
prepare, absolutely. The other thing that was quite an interesting that I've got as one of my big ones was the property changes.
Yeah. So there'd been a lot of talk about whether she's going to put national insurance contributions on property, because at the moment you just pay income tax on any profits you make from renting properties out.
Yeah.
Similar to dividends, just going to put an extra 2% on the rate, basically. So it's creating a new rate for properties specifically.
Just on properties?
Yeah, and that's from April 27.
Okay.
So that doesn't come in April 26 like the dividends. You've got another year till that comes in. But it does mean currently basic rate 20%, 40% for higher rate, and then additional rate 45%. 2% on top, so your basic rate on any property rental income is going to be 22%.
So basic rate's 50 grand and below.
Yeah.
So if all my total, so basically I've got a salary, let's just say, of 20,000, and I've got a really good rental portfolio in my sole name, with £30,000 worth of convenient maths here, adds up to 50,000, would you believe? So my rate of my £30,000 worth of property income after 2027
will be at 22%.
It'll be at 22%, and then I'll go, say I've got a 50 grand salary, and I've still got my same 30 grand. That's going to be then at your 42%.
42%, yeah,
wow.
And then additional rate would be at 47%.
47%, yeah, wow.
Yeah, so it's going to be a bit of a change.
It is, but again, time to plan.
That's it, yeah, plenty of time to plan on that one. So
what are we thinking about properties? One of the things that comes up, obviously when you sell properties, is capital gains tax.
Yeah.
So I think there was rumours of them changing the rates, but I don't believe they have changed the rates.
No, there is always rumours that the rates are going to change on capital gains, especially around properties, but they haven't changed. Still 18% if it falls within your basic rate band. Anything above that, 24%. So.
Okay, so that hasn't changed.
Yeah.
But so when I sell a property, I have a time limit to be able to file my capital gains tax, I almost said corporation tax then, my capital gains tax return.
Yeah.
Okay.
So you have 60 days from the date of completion of the sale to report and pay the tax to HMRC.
Okay. And if I file it late, what happens?
Late filing penalties. So and late payment interest if you don't pay on time. So it's something to speak, as soon as you really get an offer accepted, come and speak to us and we can get the ball rolling with getting you set up to report the game.
And they've doubled the penalties on that, haven't they?
That's for corporation tax.
That's for corporation tax, not for capital gains.
Yeah.
Okay. So for corporation tax, while we're here, while we mentioned it.
So that's another thing in the budget, that was sort of snuck in. It wasn't in the headlines, but corporation tax, if you file your return late, the penalties are doubling for that. So previously, if you were a day late, £100, that's going to be £200.
Okay, right, yeah. So that's one that wasn't mentioned, but it's always something to bear in mind. Obviously, the ideal is we don't file it late.
Yeah.
But if we do file it late, be aware the penalties are changing.
That's it. Yeah, we always aim to get it done on time, but sometimes things happen that are out of your control and you can't get us the information.
Absolutely. Do it earlier, prepared, and you have 9 months and 1 day from the end of the. Well, you have 12 months you have 9 months and 1 day to pay the tax from the year end, and 12 months to file the corporation tax return.
Corporation tax is always that weird, not aligned with the payment date and the filing date. So.
Yeah, I think that's probably the only one, isn't it? The only tax year that's like that is. So they're the main ones that I think will affect the majority of people.
There's savings income as well.
Oh, okay.
So the rate for savings income, similar to property, from April 27, an extra 2% on top. So at the moment it's 20%, 40%, 45%, so it'll be 22, 42 and 47%.
Blimey, so that's gone up by 2% just on the savings.
Just on the savings, and again that's from April 2027.
So both the 2% have come in from April 2027.
But your basic rate taxpayer, you still have your £1,000 saving allowance, which is tax free.
That hasn't changed.
No,
that's good news. Then that's good. See, there is some good news. It's not all right.
Things haven't changed. It's good news.
Yeah, absolutely. Yeah, it is. It is these days. It is. Yeah.
Yeah.
So for other things that have come up, so they're frozen personal allowances. That's still
frozen personal allowances, the basic rate threshold, the high rate threshold, all of those have been frozen now till 2031.
2030, blimey. Oh, that's for another couple of years then?
Yeah, so originally I think they were supposed to unfreeze at 2027, 2028, but that's been an extra 3 years on now. So
okay, so yeah, with national minimum wage going up, which is probably the next one, and they just sort of just walk straight into is good. So that with that going up, obviously more people are going to start paying tax, aren't they?
That's it, yeah. That's why some people talk about it being a stealth tax with the freezing thresholds, because more people fall into paying tax with them not increasing in line with salaries.
Yes, the national minimum wage has gone up. What do you know it's gone up from, Mark?
I think it's gone up 50p, isn't it? I think it's gone up to £12.70, has it?
£12.70, yeah, £12.70, yeah. Is the new national minimum wage. So obviously, with that going up, obviously more people will start paying tax.
They will, yeah, and it's an extra cost to employers as well to factor in if you've got employees. Obviously, you've got to factor that in, that the hourly rate you're going to have to pay people on the minimum wage. It's now gone up.
But no change to national insurance?
No change to national insurance on that part.
Brilliant.
There is a change to national insurance with salary sacrifice and pensions.
Ah, okay.
Which probably was where you were going next.
So I was going to be walking into that. I was going to warm up a little bit on that. But yeah, so obviously no minimum wage. Sorry, minimum wage. I've just done the minimum wage. National insurance on salaries.
Yeah.
As an employee has not changed.
Has not changed.
Self-employment hasn't changed.
Hasn't changed.
But when we talk about salary sacrifice for pensions,
yeah.
What's changed with that then?
So currently you can give up part of your salary and you don't pay income tax or national insurance on that if it's going into your pension.
Okay.
So what's changed is there's now a £2,000 limit. If you sacrifice £2,000 of your salary to be paid into your pension, still no tax, still no national insurance.
Yeah.
Anything above £2,000 is now going to attract both employers' national insurance and employees' national insurance.
Right, okay, so a lot of people were doing that, weren't they? They were sacrificing, say, let's just say I've got a 50 grand salary, if you like me 50,000 today for some reason, and then you put £10,000 into your pension, okay, absolutely fine. You'd only pay tax, national insurance and employers' NI on the 40,000.
Exactly, yeah.
Okay, so there's obviously that's where they're trying to capture that then, aren't they? So if you put the £10,000 in again, you've got £8,000 then, you're still going to suffer employers' NI, and the employers are still going to pay employers' NI on.
Yeah, exactly, yeah. So it's something that a lot of people did to try and stay within certain thresholds. So if you're going over £100,000, that's when you lose your personal allowance.
Yeah.
A lot of people would sacrifice part of their salary to keep them back under the 100,000.
But that's where makes sense. I understand why they're doing that now. Makes sense. So the other changes that they made, because those are the main ones, I think. The other thing that I think is going to affect an awful lot of people is electric cars.
It is. It is.
Not the electric cars actually themselves, I'm sure they're lovely, but they've made a change of those. And by the way, before we move on, actually, that change for the salary sacrifice comes in
April 29, isn't it?
April 29, so we've got a bit of time before that, so there's still time to plan and maximise pension contributions in the meantime. But in 2029, then that's what we've got to be prepared for.
It is, yeah. So they're giving that time because it's a big change to how payrolls are run and everything, so it's only fair for...
Yeah, I don't want to miss out on that little date. But yeah, so the company cars, so electric cars.
Electric cars in general, in general.
The board. Obviously, a lot of people have them as company cars because they're very tax efficient. Not going to go off on a tangent about that one, don't worry. That was a different podcast. But effectively, what have they changed?
So electric cars obviously have a lot of tax incentives to get people to buy them because better with the environment and all of that.
Yeah.
So they're trying to push people that way by putting tax incentives on. What they're doing now is putting a tax on them of 3p per mile.
Okay.
So normally you just pay your road tax at the start of the year and you're covered for that the next 12 months. You're now going to have to pay 3p for every mile that you do if it's fully electric. If it's a hybrid, it's 1.5p per mile.
That's your plug-in hybrids, effectively.
Plug-in hybrids,
okay. Or any, because I suppose you're self-charging hybrids as well. So any hybrid would be 1.5p.
Yeah. So 1.5p if it's a hybrid, 3p if it's fully electric.
So that's the miles that I travel,
Yeah.
not on the battery miles that it can do.
No, that's on the miles that you do per year.
Right, okay.
How that's all going to be regulated.
I was about to say, how's it be covered? When does that come in from, Mark?
From April 2028 that comes in.
So from April 2028 the mileage thing comes in with the electric vehicles.
Yeah, which is probably because they're trying to work out exactly how that's going to be reported.
Yeah, that's an interesting one, isn't it? Because is that based on your MOT certificate?
It could be, but if it's a brand new car, first 3 years, no MOT.
Yeah, I was about to, that's it. Yeah.
So
interesting.
Yeah, it'll be an interesting one, and it is an added cost. So if you do a lot of mileage, an electric car is probably a good goer for you, saving a lot of money on fuel.
Definitely, yeah.
But 3p a mile, it might mean you need to reevaluate whether electric is the best for you.
With the tax savings, with everything else as a collective, really, isn't it? Because the corporation tax savings or the income tax savings are good.
Yeah, they're still there. From a personal and company point of view, it's just adding in this 3p per mile that you do.
Yeah, which is going to be interesting, I think, isn't it? And the 1.5p you say was for hybrids. You know, I mean, they're the main sort of big things that I've seen.
There's a couple of other little things on property. So if you're lucky to own a property worth more than 2 million, there's going to be an annual charge of 2,500 on that.
So that's on top of your council tax?
On top of your council tax, and then if you're lucky enough to own a property worth more than 5 million, that goes up to 7,500 for an annual charge.
Just on top of my council tax, I've got to pay for the privilege of living in that house. 7,500.
Yeah.
Or
2.5 if it's over 2 mil. Yeah.
Okay. Wow.
So that's something that's new, and how the valuations are going to work on that. I know it's going to be based on the April 26 value.
So was there anything changed? Because there's rumours about things changing with ISAs.
Yes.
Was there any change with the ISAs?
A little change. There was talk about them being big changes to ISAs.
Yeah, like halving your allowances and all those sort of things,
So what's changed is now you still have a £20,000 limit, but only £12,000 can go into a purely cash ISA.
Right, okay.
£8,000 has to go into a stocks and shares ISA.
Right, so if I'm putting all mine purely into a cash ISA every year, at the moment I'm whacking in my 20.
Yeah.
I can only put 12 in going forward.
Exactly, yes. Okay. So, but you could then put another 8,000 to a stocks and shares.
So it's still your full 20, but if I don't like stocks and shares, and I just want to put purely into cash, then that's where it would be.
Yeah. Point to note on that is that's only for people under the age of 65. So if you're over 65, no change. You can still put in your full £20,000 in cash.
That's a curveball, isn't it? Wow.
It is, but we're expecting a lot bigger changes.
So if I want to put it purely into stocks and shares,
full 20.
Full 20. It's just if I want to put it into cash.
Cash is restricted to 12,000.
That's an interesting point.
It is, and it's something that people should be aware of because they're a really good saving and.
They're brilliant, aren't they? You get your interest with no tax, but if you're putting in more than putting in 20 at the moment, you've got to be thinking of other ways, I suppose. Yeah.
The other thing that did come up, which affects quite a few of our clients that are non-residents. So
we're going down that one. Yeah, okay.
So if you're a non-resident, you used to be able to pay voluntary Class 2 national insurance contributions.
Yes.
Which is a really good, cheap, effective way because Class 2 national insurance is the 170 odd pound a year roughly.
Which protects your state pension stamp.
Yeah, it gives you a qualifying year for state pension. So as a non-resident, you could register to pay that voluntary, and every year then you get a qualifying year towards your state pension.
Yeah.
That's been scrapped, so you're no longer going to be able to do that as a non-resident.
Okay.
You're going to have to pay Class 3 instead.
Which is your voluntary contributions.
Yeah, which is a lot more expensive. It comes out at roughly £800-900 a year on average.
Yeah, so that's an extra 700 quid or 600-700 quid you've got to put it in, effectively.
So it's going to be weighing up whether it's still worthwhile doing that if you've got other pensions and if you're paying into pensions in the country that you're now living in. But that's only for non-UK residents.
Yeah, so for anybody that's still a UK resident, no change. It's just if you're not. Wow. Okay. An interesting one that was mentioned, which there was rumours about, obviously with the VAT and putting VAT on different things, which didn't happen. But it was the sugar levy that's coming on milk products, I believe. So that's on milkshakes.
Yeah, milkshakes. Yeah. So there's a sugar tax basically coming on milkshakes, and it's.
There's a curveball that one was. I didn't see that one coming.
No, we were expecting big changes to VAT. There was a lot of talk about them dropping the threshold down to bring more people into being VAT registered. But none of that happened, which is, from an admin point of view, a good thing for people.
Yeah.
Because a lot of people with smaller businesses don't want the hassle of having to
file quarterly. And
from a
VAT point of view, obviously there are other changes coming for filing quarterly, but I'm not going to go off on a tangent on that one. So the sugar tax. So if you are selling milkshakes, that's something you really got to remember and bear in mind, that there's now the sugar tax on milkshakes.
Not be caught out by it.
Yeah, absolutely. That was an interesting one that came up. So there was probably one last one I've got in my head that I can think of that was quite an interesting one that came up, and it's something that it's becoming more and more popular actually, which is if you're looking to sell your business. You can sell your business and without going too technical into it, because it's a case by case. There's a lot more factors I'm going to mention here to consider. But in simple terms, if you sold your business to what we call an employee ownership trust, which in theory is, in practical terms, is a trust owned by the employees and for the benefit of the employees going forward. Okay, so you used to be able to sell your business in simple terms to the trust and pay no tax.
Yeah, 100% tax relief basically on it.
So you pay £0 on that. So they've changed that, and they've realised that people are selling their businesses and paying no capital gains tax on that, or with the business asset disposal relief and all that sort of stuff, which has changed now. That's 14% in the 25-26.
Yeah,
and it's going to move to 18 in 26-27.
Yeah. So
people aren't paying that because they're selling it to the trusts. So they've changed that now, haven't they? So the limit now, I think, isn't there?
So instead of having 100% tax relief, it's being cut to 50% tax relief. Okay. So 50% of it be liable to capital gains tax.
So if I sell it for £3 million,
1.5
would be
taxable.
Okay, taxed as capital gains tax.
Yes.
Okay, so that's back to my 18 and with that level it'd be 24%, wouldn't it? But 18 and 24.
Yeah.
That's quite an interesting change actually that's come in.
Yeah.
That's probably the only thing that affects business sales, really. That's coming.
It is, yeah. No changes to business asset disposal relief.
No.
I've done a few things to that in the past, and those changes are still being implemented over the next couple of years. So.
And no change to inheritance tax.
No.
One thing that was really heavily publicised that was going to change.
Yeah.
And it hasn't. It hasn't come in.
And that is something that's been worrying a lot of people.
Yeah.
That and the pensions. People are worried that they take away the lump sum, tax-free lump sum from pensions. So people have been trying to make decisions before the budget, but it's a really hard one to do. You've got to wait and see what actually happens, because we seem to more and more get a lot of speculation pre-budget.
Yeah, absolutely, and that's the thing, isn't it? There's more and more, and all these rumours that are coming out and all that sort of stuff, and that's one thing that we're going to be quite conscious on the podcast going forward. Is going to be looking at myth busting.
Yeah.
There's a lot of scaremongering out there, and that's something that we're going to try and sort of like justify, explain, and sort of myth bust really.
Yeah. Tell you what is facts and what's
fiction, really? or what people are saying that is missing out a key point, which is going to be quite interesting. Just on the minimum wage, it's £12.71 to change. It has gone up by 50p, as you said, from £12.21 to £12.71. We missed the penny off, but in theory, around
50p.
It's got 50p. I don't think there are any other key ones that affect.
No.
The mainstream, really. There are other changes out there, like things are being frozen, like fuel duty's been frozen, which is expected really. You don't want petrol prices going up too much, do we?
No, there's increases to online gambling and things like that, but it's a bit out of our...
They're more of a case by case really than affect the general. So rather than putting you all to sleep talking about the changes in those things that don't necessarily affect. But if you have got questions about anything that we haven't mentioned, like the gambling taxes changes or the fuel duty being frozen or whatever, then by all means just give us a shout.
Anything in the budget, if you're worried about how it's going to affect you, just get in touch with us, and that's what we're here for, here to help.
Absolutely, that's what we try and do, isn't it? We try and help always. So if I've got any questions then, Mark, what would be the magic number I've got to text?
01905 777 600.
I said text, and it's WhatsApp, isn't it? Your WhatsApp.
Text, WhatsApp, you're showing your age.
Absolutely, I am showing my age. I am.
Get the carrier pigeon out.
Absolutely, but that's any questions, just ask, and either of us will be more than happy to discuss them or talk about them. Yeah. Well, that's us before Christmas now, I think, isn't it?
It is, yeah. So thanks for joining us, and hopefully you've found it useful and found some little bits out from the budget that you didn't know before.
Absolutely. Well, Merry Christmas and Happy New Year.
Thanks everyone.
Thank you. Thanks for listening.